we want to bring in Mark Zandi. He's Moody's Analytics chief economist here. Mark, it's great to see you. So talk to me just about your reaction to this print and ultimately what it signals, do you think, for the Fed?
Great news, Shauna. It was pretty close to script, even a little bit better than script. It shows that inflation is moderating steadily, coming back into the Federal Reserve's target. My favorite measure of inflation, and the measure that I think gets to underlying inflation, is the so-called harmonized CPI that excludes the implicit cost of home ownership, which is really tough to measure, and the rest of the world doesn't even try. And that's back to the Fed's target and has been for a better part of the past year. So, we're if we're not at target by any measure, it's in clear view. It's dead ahead, and all the trend lines look pretty good. So, given that, I think the Fed should start cutting interest rates. That probably won't happen until September. They want a couple more months of really good inflation numbers, but I think they'll get them, and we'll get a September rate cut.
What type of effect then do you anticipate that's going to have on the housing market? Because that's where we might be looking for some spur in demand if there is a cut that finally gets announced, that finally gets put into effect, and for potential home buyers that have been sitting on the sidelines waiting, or even for those who are looking for even more cuts to refinance, that's anticipated to have even more of effect on that marker that you mentioned that the Fed is going to be keeping close tabs on shelter.
Well, Brad, I think the most immediate benefit is to lower income households through lower payments on things like credit cards or consumer finance loans, buy now, pay later. Might see auto loan rates come in, and that would be very helpful for, again, lower middle income households who are been unable to purchase a car because of the cost of financing. So I think that's where we see the biggest benefit. It should help the housing market. My sense is we will see, if the Fed starts cutting rates, that'll help the yield curve become more normally shaped, and the volatility in the bond market should moderate. And that means mortgage rates, the 30-year fixed mortgage rate, should start to come in and be more consistent with the 10-year Treasury yield. So that will ultimately help housing demand. I mean, right now the 30-year fix is at 7%, and anything over 7, the housing market it feels like it goes into a deep freeze. People just can't afford to buy a home. Closer to 6, things come back to life. So I think the Fed's move, and if they can signal that they're going to continue to cut interest rates, I think we'll get rates from going from 7 closer to 6, and that's when life starts to come back in the housing market.
Mark, my question to you is, there's been more and more focus on some of the weakening that's happening within the labor market right now. Even Chair Powell commented on that down the Hill this week. If we don't see a September rate cut, how much further weakness do you think we could potentially see in the labor market then in the coming months?
Yeah, I think that would be a mistake. I mean, I think the economy is under a lot of strain from the higher rates. It's doing some damage. The labor market is the most obvious place. I mean, hours worked are down, temp jobs are down, the hiring rates, quit rates are down. The job growth is slowing. All the revisions we're getting now are to the downside. They're reducing estimated job growth. So unemployment insurance claims are up. That might be more seasonal than anything. We'll have to see, but it does feel like businesses are, starting to lay off a bit more. So yeah, I worry about that if the Fed keeps rates here too high for too long. And of course, the other kind of stress point is the financial system, the banking system, and the broader financial system, because the yield curve is inverted. Short-term interest rates are higher than long-term rates, and that is a very uncomfortable place for folks in the financial system trying to make some money on their net interest margins. And so I worry that we could see some other type of event in the financial system. So I think it's really important that the Fed follows through here and starts cutting rates.
Mark, what does that type of event potentially look like? And talk to us a little bit more about what maybe some of those stressors could trigger when we talk about that wider fallout.
Well, there's a few. I'll call out one. The bond market, it feels really choppy. The liquidity in the market is very poor. And that goes to a number of things. Most significantly, the broker dealers, the divisions of big banks that do the trading in the bond market, they haven't increased the size of their business, their balance sheet, to be consistent with the growth in the amount of debt outstanding. We've had all this treasury debt, that's been because of the large budget deficits, and the broker dealers have not kept up. That goes to capital rules, and it's not economic for the banks to invest in these broker dealers. and that's adding to the problems of liquidity. The other is the quantitative tightening. The Fed is pulling out of the bond market through its QT, and that means some other buyer has to step in. It turns out that that buyer are hedge funds, and hedge funds are obviously very price sensitive. They're there when things are going well, and they immediately leave when things aren't going that well. And that creates a lot more volatility, makes the bond market more fragile. So in this high rate environment with that QT, that's a flashpoint. That's a stress line in the system that could be a problem if the Fed keeps rates here too high for too long.
As we were taking a look at one more component within this that had been part of the sticky inflation kind of narrative that we had seen report over report, essentially, that moved a different direction and offset housing, it was energy. That's going to continue to be kind of one of the more volatile pieces, perhaps, of this. But is there some stability that energy could even bring to the inflation print on a go-forward basis from here?
Well, as you point out, energy prices, particularly oil prices, go up, down, all around. So that always makes me nervous. I mean, that's the one thing that could upset the apple cart here. But having said that, it does feel like oil prices should stay down. I mean, we're getting a lot of production coming out of the U.S. The frackers have done a marvelous job ramping things up. Here in the U.S., we're producing well over 13 million barrels of oil a day. Brad, just for context, the Saudis and the Russians are producing 8.5, 9 million barrels a day. We're the largest oil producer on the planet by orders of magnitude, and that's helped to fill the void left by the Russian sanctions and OPEC plus production cuts. So that's helped quite a bit. Also, global demand has been on the soft side. Given the weak Chinese economy, given the move here to hybrid and EV, reducing the demand for gasoline to power our cars. So that all augurs well. But having said all of that, I really worry because there's a lot of cross currents, global demand supply factors that affect the price of oil and could blow in the wrong direction here. But right now it feels okay. It feels we got a tenuous kind of a calm here at the moment.
Mark Zandi, always a pleasure to grab some time with you, and thanks so much for breaking down this CPI report with us. Moody's Analytics Chief Economist. Great to see you, Mark.
Thank you.